What's up, everyone? It's Caddy with Money Vesting. So just wanted to go live here for about 30-45 minutes. I know it's pretty late again over in the East Coast, but futures are not looking very pretty. We've got the NASDAQ futures down about 2%, trading as low as 11,600. We've got the S&P futures down a little bit over 1.5%, and the Dow futures are down over 365 points, or just over 1%. But NASDAQ certainly taking the brunt of the pain here. It's definitely a much bigger hit than some of the other indices. And if you do open down 2% tomorrow, which is what it's looking like right now, then we are looking at a potential open at around 11,111. So just 5 ones. That's going to be potentially the open. We're still not going to take out our lows from May 16th, the week of May 16th, but it is going to be a very, very critical test on Monday, whether the markets do get bought up or if we continue or if we accelerate to sell off even further. So Asia markets also tumbled. Japan, South Korea, and Hong Kong, they were all down more than 2% as tech stocks fall. And of course, the Fed will raise rates in the week ahead, but what Chair Powell says may matter most. We've already talked about all of this in a lot of detail. Jerome Powell's Fed speech is also coming up on Wednesday, June 15th, and they're also going to release a summary of economic projections. We already got those inflation numbers last Friday, and on Tuesday we've got the PPI numbers also coming out. So it is a week full of excitement, interesting data, and of course the price action, which is going to be a pretty significant battle between the bulls and the bears to see if the bulls can hold up those levels or not. So once again, thank you so much for joining, everyone. I really appreciate it. Make sure that you drop a like. Marcus says cracking open a beer. A salute. So yep, cheers to you. And Bruce, welcome on board. Iceman, welcome. Good evening. So all right, let's see up. So Bitcoin and Ethereum have absolutely been plummeting, right? So there we go. We got Bitcoin down over 3% right now. Yesterday it was down over 6.5%, trading as low as 25,000 now. So definitely breaking down from these support levels pretty aggressively. And now unfortunately 20K is the next support for Bitcoin. And for Ethereum, the next support really is going to be, let's see, wow, this is a pretty brutal drop here, selling off over 5%. And the next support is going to be sitting roughly around this level at close to about 1286, 1285. Around those levels is going to be next for Ethereum. But big breakdown here for Ethereum as well. So cryptos getting, so this is a little bit of a risk-off environment anyway, so you'd expect something like crypto, which is a little bit more risk-on in nature, getting sold off, because last week we saw consumer defensives do a lot better, at least on the day, not so much on the week, but on the day consumer defensives were still holding up much better than the other sectors, but it was just brutal across the board, and all equities, all stocks, all sectors were selling off. So in this market environment, it's energy and oil is the only place that has been doing better, like that's been doing well, but everything else has just been selling off. So there's nowhere really to hide, given what we're seeing right now. All right, Phil says, well, I did warn you, all history repeats always. So, okay, thank you so much for the warning. I really appreciate that. Let's see, looks like another buying day, Bruce. So, yep, dollar cost averaging on Palantir and ATAI, says Randy. So Palantir, let's take a quick look. And I'll go over some of the individual companies as well. We'll go over some individual stocks for you. Let's see, Palantir here sold off last week, down over 7.6%. Next support is going to be roughly in the 740s, 750s, where it kind of bounced off of. So that's going to be the level to watch. And of course, we're still struggling to actually break out of that resistance at 9 and all the way up to 1060. But of course, Palantir has been under tremendous pressure along with the entire market. And this has been one of the worst starts for the S&P 500, as we've talked about, in over 90 years. So we've seen a lot of selling pressure because of a lot of different macro backdrops. I was also reading there's now global food shortages. Rice could be next that starts to push higher, but overall food prices have just jumped significantly over the last several months, as India has also banned exports of wheat and a lot of other commodities, along with what's happening over in Europe as well. So we took a look at the inflation report, and we looked at the individual line items, and some of the really interesting takeaways from that was, clearly energy, even though it makes up a very small portion of inflation, which is about a tenth of inflation, about 8 to 10% of CPI is coming from energy. That is still the biggest driver of why inflation is elevated, and it's still higher. So if you exclude energy, right, if you keep food in there and you exclude energy, it goes from 8.6% on a year-over-year basis down to 6.6%. So full 2 percentage points are coming in from energy, even though it's making a very small portion of the CPI numbers. And if you take shelter out, if you don't include shelter, then CPI is actually higher. It's going to be at over 10% because food and energy would obviously drive inflation at a much higher level. So it's a good thing that we're including shelter, which is obviously, bringing it down to closer to 8.6%. But if you take out, food, energy, and shelter, and I think used cars, and we're sitting at 5.8, under 6% for the prices. So I was thinking about this the other day, and it was just trying to understand where inflation's coming from and where these price hikes are just very, very contained in. Obviously, energy is one of the places where there's been a lot of price increases. Food is another one because dairy products, eggs, milk, tomatoes, all those things that we talked about in that video are obviously pushing higher. So I was thinking about what Kathy would said, right, in a couple of videos ago, and she talked about how inventories are going higher. There's been a surplus of inventories. And she could be right and wrong at the same time, because if you take a look at commodity inflation, which is commodities excluding food and energy, we're not talking about global shortages of food and or energy commodities. We're talking about other things, right? We're talking about used cars and new vehicles and commodities other than food and energy. They've actually now started to come down, and they've been very consistent or stable over the last several months. They haven't really accelerated all that much, and you'll see that in that video as well. When you look at services excluding shelter, which is your medical care services or transportation services, and airline fares is the only small piece within transportation services that's pushed up, but every other service apart from that has not really moved, anything compared to what we have seen for energy and food. So most of that's contained within, I would say, energy and food. Those are the two sectors that's obviously total CPI is driving higher. But if you look at core, if you exclude for those numbers, you're now starting to see that big divergence, right? Core CPI is now starting to come down on a year-over-year basis, and totals still going higher. So, all that was covered in that video, but the whole point of that video was to go over individual line items and to really understand where is that inflation coming from for the most part. But there still seems to be a lot of fear in the markets, absolutely. And, NASDAQ here down close to 2%, as I pointed out earlier. S&P and the Dow Jones also selling off even aggressively today. And we'll see if, that support level holds up, which is the NASDAQ's 50 EMA sitting roughly at 11,100. Chances are we're probably going to open around those levels tomorrow. And after the open, I think that's going to be the critical test for the NASDAQ, whether we see some buyers step in or not. So 22... Scratchers, thank you so much for that donation. I really appreciate that. So love your channel, even if I don't comment much. So thank you. I appreciate that very much. So come on, Caddy, core CPI is a con. Who can exist without food and fuel? Yeah, so that's right. That's exactly why I was mentioning in our previous live stream that the Fed has little to no control over the situation, right? Because core CPI, even though it excludes food and energy, is somewhat irrelevant. What's more relevant is the total CPI, food and energy, but they can't control the supply of those two things, right? They can't control the supply of food or energy, right? They have no control over that. They can't produce more food or energy. All they control is the demand side of things. All they control is, and more so, they only control the discretionary demand. They're not going to force people to not spend money on food and gas. So that was the whole point of last Friday's video, is that the Fed's lost it. The Fed has literally no control of the situation or the narrative, and this is now changed into more of a different type of issue, a more fiscal, more political issue, where we got to figure out how to solve one of the biggest problems right now is supply chains, and when it comes to food shortages and supply of energy and oil production. Those are bigger problems than raising rates or not. I don't think that's primary. Raising rates, great. We can go up to 50, 75, 100 basis points, sure. But that's not going to fix the problem when it comes to supply of food, right? Supply of energy. So that's the whole idea behind how the Fed is lost the narrative, like lost the control over the entire inflation story. But anyway, so let's just go over to here. Let's just go over some individual companies. Let's just go over some individual stocks. All right, let's see. Let's take a look at Tesla. So Again, Tesla, Amazon, Google, a lot of these tech stocks are probably going to open much lower tomorrow, given where the actual futures markets are. So this right here was or is still the inverted head and shoulders pattern that we're watching right now for Tesla, but trading as low as 690 to 669, and after hours it did push higher after the split announcement. So for that 3-to-1 split, it was trading as $709. So Tesla may open flat on that catalyst, may open just about at around 700, 710, around those levels. So that is, so to food and energy, add healthcare. Abel, thank you so much for that donation. So what do you mean add healthcare? Are you saying like add healthcare to find out what that inflation number is going to be, or what does that even mean? So for Tesla, like I was saying, 3-to-1 split coming up August 4th, I think is when the meeting is, a shareholder meeting, and they need that approval to go through with that stock split, which I do think that's going to get approved. But $700 is probably where I expect Tesla shares to open, around those levels. And then we'll see where we trade throughout the day, given the situation with the NASDAQ, the S&P, the Dow, and leading up to the PPI numbers on Tuesday, and of course the Fed meeting on Wednesday. Talking about Google, now Google is, and I've already mentioned, has been trading at a very attractive price point. It is down quite a bit from all-time highs. Valuation multiples have compressed substantially for Google. My fair value sits roughly in the 1800s for Google, given a very conservative growth estimate, and a PE multiple. So $2,000 is going to be that support level to watch for Google right now. And if it does sell off, another 6, 7, 8% down to those levels, then I'll be a little bit more aggressive, dollar cost averaging around those levels here. And I have noticed a lot of sort of so I have noticed that dollar cost averaging, obviously people have turned away from dollar cost averaging, that people don't want to DCA in this environment, is what I've noticed, given the situation. I mean, it's much better to be picking up shares here than it was a year ago, right? Shares were much higher, stocks were much more expensive than where they are right now. So in my view, obviously you have to pick and choose. You have to be very selective in what you dollar cost average into, and not everything is going to be a quote unquote deal at these prices. But if you do find them, regardless of whether they're trading in a downtrending pattern, regardless of whether they're making a lower high and lower low, like for Google, for example, it's still in a pretty much a bear market and it's just trading inside this downtrending channel. I'm still not going to sit on my hands if stock price just comes down to, let's say, 2,000 or 2,200 or 1,800. Like if those are the levels that I have predetermined that those are buy targets for me, it doesn't really matter what the price does, right? As long as the business is doing well, as long as the fundamentals are doing well. And that's what dollar cost averaging is all about. And if it does sell off, then I will keep buying. I will keep dollar cost averaging. So, all right, let's see here. So Wilson says, in this kind of environment, should we just buy energy and food stocks? So Wilson, that's a great question. And one of the things that we've already talked about is why. Why is energy higher right now? Why? What is the main reason as to why energy stocks are the ones that are pushing higher? I was actually taking a look at ExxonMobil yesterday, and I was looking at the monthly chart. And I'm actually really tempted to buy a put on ExxonMobil. Does anybody want to take a guess why that is? Because I was looking at ExxonMobil the other day. Like yesterday, I was looking at this stock, trying to do some analysis, looking at some put prices, looking at strikes, and it is getting to a level where I would be more inclined to either buying a put or shorting this as opposed to going long on energy. And the reason is very simple, because their earnings were very, very strong for the quarter, right? For the first quarter, they actually grew 250%, right? So 250% was their earnings growth. And obviously, when we have that type of earnings growth, Wall Street wants to flood into this sector because earnings growth are very strong and they're expected to be strong over the course of at least next couple quarters. I do think and I do believe that starting at the end of 2022, starting 2023, and let me show you guys what I'm talking about here. So if I go over to Seeking Alpha here, and let me just bring up, let's say, Chevron. Like we'll talk about Chevron in this example. And you go over to earnings estimates. It's all about earnings for Wall Street, right? That's all they care about. If interest rates, inflation, if these recession fears, if all this macro headwinds creates an earnings drop, they ditch those companies, and whatever has earnings growth, they go after them. So if you take a look at earnings estimates for Chevron, you come down to here. Take a look at what's happening here. So for fiscal second quarter 2022, they're expected to grow earnings by 178%. 178%. That's an insane growth for EPS, for earnings per share. For the third quarter this year, they're expected to grow another 64%. And for the fourth quarter, they're expected to grow by 75%, right? This is all as a result of oil prices staying higher and where they are. So in my view, I think all of this is already getting priced into the chart, which is why, Exxon, well, we're talking about Chevron, so let's just go over to Chevron, which is why Chevron has, rallied quite a bit from $64 all the way up to $180. It's up over 178%. Year to date, this stock's up 49-50%. So very, very strong move. And same thing with ExxonMobil, right? It's up, I think, 270% from those October 2020 lows. It's up 234%. But look what happens starting 2023 when they start lapping over some of their toughest comps in the history of the company. They actually start decelerating down to 16% and then start declining back under $4 in EPS. So 14% decline, 20% decline, 20% decline, the negative 24 basis points. I think this is going to be about the time when we're going to see a little bit of a rotation from these oil stocks, from these energy companies, because like I said, this is not sustainable. For no company it is sustainable. Not for Amazon, not for Google, not for energy companies. No company in the world can do earnings per share growth of 100% consistently or 50% consistently over a long period of time. So I think this is what Wall Street's looking at, near-term estimates, which is the next couple quarters, and oil prices staying pretty elevated looks very, very good, no doubt, and energy completely deserves that because it's been the biggest underperformer for the longest time, and now we're starting to get to some of the extreme levels, and you can see the RSI, and this is the monthly chart, by the way. We're not showing you the daily or the weekly chart. I'm looking at the monthly chart, and looking at this monthly chart, we're getting up to, there's a couple different things. Resistance of 105, which is the all-time high for ExxonMobil here. So, you can see that last time we were at this level was back in June of 2014. So we perfectly validated that level here. And right now we're getting up to that resistance once again. Take a look at the RSI, overbought at 75. And the MACD is also overbought at, trading well over its signal line. And we talked about the earnings as well. So there is going to be an opportunity. I do think there's going to be an opportunity, and we just got to keep our eyes and ears open and to see when and where there's going to be a potential pullback in overall energy and oil companies, because there's just no way that this thing continues to go higher, given that how overbought it already is on a monthly chart basis. So I'm definitely paying attention to this, and in our Discord I'll let everybody know if I'm actually going short on oil moving forward. So I was thinking Jan 2023. So Kevin says me too. Yep. So we'll talk about that in our Discord here. So sorry 87, how cool, first time watching it live. Greetings from Montreal. Good luck everyone next week. Thank you so much for joining. I really appreciate that. Shivam says oil is going to crash. Heard it here first. Well, I wouldn't necessarily call it a crash, but I do think that there is going to be a pullback. There's just no way that anything goes up like this forever, indefinitely. And I know there's a lot of recency bias kind of built in that if this is going higher, this is where we need to be. This is, just going to keep going higher and higher and higher. That's what happens when stock prices move higher, right? We tend to think that, okay, this stock is the one, it's just going to keep going higher, and we tend to sort of overpay for that name. And when stocks are falling, when they're coming down, everybody wants to not invest in that company. They're like, okay, it's just keep going down and down and down. So I mean, it's just weird how, Tesla, there were people willing to pay $1,200 for Tesla at one point, and now people are not willing to pay $700 for the stock. That is market psychology 101 in a nutshell, where you'll find buyers when stocks are going up, but you'll never find buyers when stocks are going down. So, and that's the type of market we're in, where there's a lot of deals, in my view. There's a lot of stocks that are trading at very attractive multiples, but there's just no buyers because of all the fear that we have in the markets overall. Okay, so let's see. And over the next, let's say a couple months, it all really depends on what happens with the supply of oil. I wouldn't be surprised, like I said, for us to get up to 147. I think 147, 150 is still that target, and that's going to make oil companies even more overextended to the upside. And it's going to lead to, in my view, a much better and a bigger risk reward trade-off when it comes if you are looking to kind of short on the downside. But 147, 150 is still a possibility on oil overall. So we'll see if it gets up to that level. 147, 150 is also its previous high from 07, 08. Okay, so let's see. Kevin says, I bought Tesla 15 minutes before your alert, Caddy. That's great. That's awesome. All right, give me stocks. Let's just go over some names here. Let's take a look at NVIDIA. Again, this is time for you guys, for me to go over stocks for you. And I'll just go over them before the week is getting started because it is about to be really volatile. And at the same time, we've got some very, very important charts to look at. So NVIDIA here sitting at around 169, 150s is going to be that support. One of the important levels to watch on NVIDIA is going to be this overall chart that if you come over to the weekly time frame or even the monthly time frame, this has been the overall pattern for NVIDIA stock, right? It's been perfectly validating this support time and time again. This is coming in since 2015, so we're going back 7 years. Very nice validation. We came down, perfect validation here. We pushed higher. Right now, we're once again at that support. So it's really important to watch that higher low. And if we do sort of break down below this, then unfortunately, there's going to be more potential technical downside for NVIDIA as well. But for now, this would be the level to watch for NVIDIA. Apple here, then we'll take a look at AMD. We'll talk about SoFi briefly as well. So Apple also has a very, very important support level to validate, which is going to be this higher low. So that's going to be this ascending support level here for Apple going into tomorrow because we're right there. A couple of weeks ago, we once again came down to that support. I also talked about that in a video, and then we got bought up. Apple pushed up 13%. But we're right back down to that support once again. We'll see if Apple has what it takes to validate this higher low. This is a multi-year, multi-decade support here for Apple. First one's going to be here, but if you do break down further, then the next support is going to be sitting all the way down here for Apple stock. Talking about AMZN here, so Amazon. Amazon also has its multi-year, multi-decade low to follow up with. And that's going to be this coming in from 1997, perfect validation time and time again. And right now we're coming down to that support once again. And if you take a look at Amazon over here, next support or that fair value is pretty much sitting at around $100. And we also talked about this in our market updates, right? It had an inverted hammer candle. This right here usually happens towards the end of a trend and usually marks a reversal. And that's exactly what happened. We saw Amazon go up, market inverted hammer candle, and then come right back down. So next support in the 100s is going to be that level. Talking about AMD here, Advanced Micro Devices, selling right back down. Next support is in the $83, $84 range. $80 I think is that fair value. And I did a semiconductor video as well where we talked about 5 chip stocks: Intel, AMD, NVIDIA, Qualcomm, and Micron. But AMD, my fair value ends up at around $80, sub $80, depending on the conservative growth estimates and P multiple. So this right here is going to be that next sort of area of support, demand inside this green rectangle. I would be a little bit more aggressive in picking up more AMD shares at those levels. Let's take a look at Facebook. So Meta here also selling off quite a bit. And this is the overall chart for Meta Platforms, which is also coming down to some very interesting levels. And this is also support for Meta that we have validated time and time again. So that's going to be this level right here. That Meta's validated since 2016. This right here, validation in 2018. This right here, validation in 2020. And right now, we're once again at those levels for Meta Platforms once again. This right here was the big breakdown from this previous higher lows. So that was the higher lows coming in since the IPO back in 2011, 2012. But of course, we broke down even further. So next support is going to be around here, this level at close to 170s or closer to 167, 169, closer to 170s here for Meta. Tesla looks strong. So Tesla we've gone over, talked about AMD, talked about Amazon, Google. Let's take a look at InMode, INMD. And InMode here also selling off, down about 5% on Friday. We are trading inside this green rectangle once again. So we did see a little bit of a bounce a couple of weeks ago for in mode when it came down to lows of $20. So from those, it actually rallied 34%. I do have a couple of covered calls on in mode. Those are up like 40+%. But if they do get up higher tomorrow at over 60% plus, then I will be closing them out to sell new covered calls on this stock once again. But next support roughly in the 20s is what we're going to be watching for in mode as well. Kevin, yes, thank you so much for that reminder. Everybody, please make sure to drop a like. I really appreciate that a lot. Meta reaches your fair value. Yep, so 170s, 180s is about that fair value. So I don't mind dollar cost averaging around these levels for Meta. Sold a put on Tesla for 640 next week. So let's see here. So that chances are that is probably going to end up being in the money given how next week is positioned with everything that's coming on board. 640 is about another 8% drop. It's possible. I'm sure the premiums were really good, but I'm sure it's very much a possibility given what we have set up for next week. It's kind of like it's a really interesting week in a way that we've got the Fed. That is going to be a big macroeconomic sort of challenge or a headwind, but at the same time, there's technicals that are still valid. They're still relevant to some extent because the Nasdaq hasn't really broken down. And again, I know that I keep bringing up this chart because, but I do that because it's so important, right? It is really important because if you think about it logically, the last time we actually broke down was back in the Great Recession, 07, 08, and before that was the dot-com bubble. Even in between those two recessions, the markets validated this 50 EMA. So it is a really interesting setup that we're going into this next week with the Nasdaq coming down to literally test this level, and at the same time we've got the Fed meeting and of course a lot of other catalysts coming up. So if this level holds, then we're still in good shape. We're positioned well for some type of expectation that okay, there's going to be potential for a bounce here, but if it breaks, then it's going to be put season all the way because there's going to be a lot of traders, investors watching this trend to see if you do break down. All right, let's take a look at Enphase. Enphase, I've done a video on this company recently actually, and Enphase got up to that resistance at 217 to 18 and now starting to come down a little bit. RSI MACD was not quite overbought but definitely a little bit elevated, and it's now starting to pull right back down from those levels. My fair value, I believe, was in the low 100s. If you guys watched that video, I think it was in the low 100s. Enphase is or has been one of the best performing stocks in the S&P 500 in the last 3 years. This is the second best performing stock in the S&P 500. The first one, of course, is Tesla, but Enphase has also had very solid gains. I mean, year to date, it's still up 7%, outperforming the overall indices, and it's performed really well over the last 1 year, 3 months. It's kind of held up very nicely compared to the markets overall. So resistance right now at close to 218, 220. Valuation multiples are still rich, still a little bit high. So, which is why my fair value sits roughly in the 100s. Obviously, that's kind of result in a decline of close to 40 to 50% from these levels. Sanjeev, Caddy, don't you think that increasing rates in July by 75 basis points will not be good for both the markets and the economy? So I think it's really important that we get these rates up as quickly as possible. Like, I think it'll be a good thing for the markets and the economy over the long term, because the more we kind of procrastinate with these interest rate hikes, the worse the situation is going to be. So yes, I think 50, 75 basis points, I think the faster we get up there, the better, because Fed will have more flexibility at that point. But right now it's kind of like, when the Fed is at 0%, when the US's economy, when the interest rates are at 0%, there's nowhere to go but up. That's the only way the Fed can go. But once they get up to 3%, 3.5%, once they get up to those levels, and they have a little bit more flexibility, and they have more levers to pull at those levels. But right now, it's just getting up there. But I also do think that all they're gonna do is they're gonna freeze liquidity on the discretionary side of things. People still need to buy necessities, which is food and gas, like groceries and gas. So I think that is more supply driven when it comes to prices. I mean, we're seeing exports on ban exports from India and from all the other countries that export a lot of food and agriculture products. And of course, we have those oil crises with us. That's not the Fed interest rates, in my view, is not going to help the situation when it comes to prices of food or gasoline. That's why they've lost the situation, the whole narrative. They're still going to put a pretty big dent on discretionary spending, and that's going to pull back a little bit of the services sector, commodity sector. People may spend less on discretionary items, but I do still think that they will have more flexibility if they get rates higher faster. But that I don't think that necessarily would be a good thing for the markets, because the hikes are much faster than what we have seen before. So if you come over to this chart here, you'll notice where we are. We're at close to 0.75 to 1%. This is where we are. And back in 2016 to 2018, that was the last hike cycle that we went through. That happened over the course of 2 years. In 2 years, we went up from 0 to 2.5%. Now we're expected to go from 0 to 2.5% in 8 months. So you get the idea how quickly and how aggressively the Fed is doing these rate hikes. In the previous hike cycle, it was more time. We did it in stages. I think 25 basis points was kind of like the norm. That's exactly what we were doing. Every hike was 25 basis points. And this, now it's like 50, 75 possibility on the table. And, 100 basis points is also starting to seem a little bit on the table given the situation. 100 would put us all the way back over 2% in one single hike from the Fed. So it's a little bit aggressive, obviously, and they need to do that because inflation is obviously running at a 41-year high, but for different reasons, in my view. Okay, so a couple more stocks here. We'll take a look at Upstart, and then I know it's pretty late over there. It's past 11 p.m., so I don't want to hold you guys for too long. So Upstart sold off here 5.5%. Last week it was down over 22%. So I don't have a position in Upstart anymore. I got out of my covered calls, got out of the equity position as well. But if it does sell off down to under $35, under $30 once again, we'll be looking at potentially setting up a new trade, maybe even cash secured puts. Maybe I'll start with cash secured puts this time. Last time what I did was I bought the shares at $33, sold covered calls at $55, and then got out of both with a very nice profit. But this time around, maybe we can look at cash secured puts 33 days out, July 15th. Let's see here. So if I do $30, you can get $250. $35, you're going to get $455. If you go a little bit further out, let's say July, then $30 is going to pay you $293. $35 is going to be $5. Which is not bad, right? That's a pretty good return. 5 divided by 30, that's a 16% return in about 40 days, right? So 16% return in just a little bit over a month. I'll take it. If I do get assigned the shares, the cost basis will be around $30, which in my view, I think would be a very attractive level. For Upstart would be around $29, $30, that support. And Upstart would need to drop close to another 22 to 22% for me to be assigned those shares. So, all right, let's take a look at SoFi. Okay. So SoFi I've actually done videos on. I've done several videos on SoFi in the past, so make sure that you do check them out to get my sort of 2 cents on the company. But making lower highs and lower lows here, so selling off, obviously since all-time highs at $25, 76% down, and trading inside this downtrending channel, getting rejected at the 50 EMA, getting rejected at $8 per share as well. So that right there is going to be that resistance level to watch for SoFi, and support level is going to stay put at close to 481. Again, it's still on my watch list. I was looking at leaps on SoFi, but it didn't quite make sense. Again, leaps are not for every single stock. You have to really pick and choose which stocks make sense for you to buy the leaps versus actual shares. Because if you end up buying a leap for SoFi, let's say that you get a $2.50 strike, a deep in the money leap for, you'll be buying it for $4, right? So that's going to be about $415, where you can go ahead and buy the actual shares for $594. So that's not really much of a benefit of you going with a leap versus the actual shares. So it's on the watch list. I'm definitely paying attention to it. I'll be covering some earnings in the future for SoFi. So we'll see how the company reports, but I'm looking for that execution. I'm looking for that positive free cash flows, those earnings. And once the company develops those, then yes, my conviction will also grow in this company for a potential longer term opportunity. Okay, so that'll be all, everyone. So once again, thank you so much for joining. I really appreciate it. Make sure that you drop a like. Tomorrow is a start of a very, very critical week, not just from a macro standpoint, but from a technical standpoint as well. Don't lose focus on that technical picture, because that is really important. And if you do break down below that 50 EMA, then unfortunately, that would be the first breakdown in over 14 years. The last time we broke down was back in 07, 08. So, pay attention to that as well. And we've got the Fed meeting, we've got PPI numbers, we've got the retail sales, a lot of things coming out. So futures right now down about 1.79%. So getting bought up slightly from those levels. So this is going to be that support from May 18, May 20 levels at 11,500. S&P is down 1.3%, and the Dow is down about close to 1%. So we'll see where we open up tomorrow. And once again, thank you so much for joining. I really appreciate it. And I will be live once again to cover the market open. If you have any stocks, feel free to ask me then. And I hope you guys have a great evening, and I'll see you guys first thing tomorrow morning for another live stream. Take care.